All right, this is exercise 12.3. I am on letter A. This is going to be for your bad debts expense adjustment. They tell you that the Samson Company had a net credit sale of $1,950,000. I'll circle that. It says past experience shows that 1.5% of those firms' credit sales result in uncollectible accounts. That means those are not going to be collected. That's going to be an estimate. So what you do, you have to do a calculation here. You're going to do 1,950,000, and you're going to multiply that by 0.015. That'll give you $29,250. That's going to be your estimated bad debts expense. And what that's going to do is that's going to trigger an adjusting entry. That adjusting entry will be what they call an uncollectible accounts expense. I'm going to write this up at the top. You'll have uncollectible accounts expense, debit for $29,250, and then you're going to credit your allowance for uncollectible accounts for $29,250. That would be your adjusting entry. So the expense account is going to be a new one. It's called they call it uncollectible accounts expense, and the credit goes to this allowance for uncollectible accounts. That's going to be a contra asset on your balance sheet. And then again, that will be your adjusting entry. And again, this is just an estimate of your bad debts expense. Very simple calculation. You just take the percent which they're giving the problem, which in this case is 1.5%, which in decimal form is 0.015, multiplied by whatever your credit sales are. This is going to be your adjusting entry. So that would be letter A. All right, now on letter B, let me get rid of these so it doesn't distract you. All right, now on letter B, we've got a depreciation adjustment. And on this one, let me click this. All right, so on this one, it says equipment was purchased by Park Consultancy for $38,220. This was on January 2nd. Has an estimated useful life of 10 years and an estimated salvage value of $2,700. They want the adjustment for depreciation for the year. So this is going to be for a whole year. This is a review from Chapter 5. Remember the calculation, you take the cost, which is $38,220 minus the salvage value. And in this case, it says the salvage value is $2,700. And then we're just going to divide by 10 because in this case they want a per year adjustment. And so when you do that, you're going to get $35.52 per year. And this will be the same as your other adjusting entries. You're just going to debit depreciation expense and credit your accumulated depreciation for $35.52. That's just like Chapter 5. So again, very similar. This is basically review stuff. This is that straight line depreciation. That would be letter B. All right, last one is just an accrual of payroll. This is letter C. It says Giant Plumbing owed $11,400 to its factory employees who were paid weekly. So that's just going to be a wages expense debit for $11,400, and then you're going to credit wages payable for $11,400. They went ahead and just gave you them out. You don't have to worry about D and E on this problem in this chapter. I'm not going to test you on the tax part of this chapter on accruals, but you should know how to do a basic payroll accrual. You would debit wages expense and credit wages payable. On the next slide, I will walk you through the exact entries just to show you the official how they look. All right, so this would be the answer you would see in Blackboard on your solutions. Again, remember this is 12.3. Notice again, we already calculated the amounts, $29,250 for this is letter A. Notice they debited uncollectible accounts expense, and then here's your allowance account, allowance for doubtful accounts. They call this thing various things. Sometimes I would call this allowance for bad debts expense, but just follow the accounts that they use in the textbook so that you do not get confused. Notice this is the expense account. The allowance account works just like the accumulated depreciation account. It's called a contra asset. It would show up on your balance sheet as a reduction to your accounts receivable. And of course, here's your debit and credit. On B, here was your depreciation expense. This is review. Notice they debited depreciation expense equipment, credited your accumulated depreciation. That's going to be your depreciation expense adjusting entry. And then finally, letter C, notice they debited wages expense and credited wages payable. That's going to be your payroll accrual. Okay, so before we get to the next exercise in your book, I want to show you an illustration on how to calculate the concept of interest. Interest goes by the theory of you take what they call the principal of the loan times the interest rate, which I'll label as R, times the time period. Principal times rate times time. So the principal will be the amount given in the problem. The rate, that's going to be an interest rate. And the interest rate is usually in the book stated as an annual rate. And so the way I do it, and I'm going to illustrate for you in all the problems, is anytime they give you an interest rate, I'm going to divide that by 12. I'm going to convert that interest rate into a monthly interest rate. And then when we get to the time period, in this textbook, they always want the time period. They always state it, or they'll give it, or they want it in months. So it's really just about keeping it with apples and apples. So to keep it simple, is I'm going to take the interest rate given in the problem, divide by 12, because that's going to convert it into a per month interest rate. And then I'm going to go back to the concept of the adjusting entry time period and simply count how many months we need to accrue on interest. It's really easy, but it's a new calculation that typically if we were actually in class, we would work this pretty much just like this. And some of you may already understand it, but the idea is PRT, principal times rate times time. That's going to equal the amount of interest on the loan. It's either going to be a note payable or a note receivable. The way you calculate that is going to be exactly the same. So this is exercise 12.4 in your book. Let's start with letter A. And on this problem, again, let's go back and read it. It says, for each of the following independent situations, indicate the adjusting entry that must be made on December 31st, 2019. So at least that sets your time period. You want this for the end of the year. So on letter A, this is a notes payable. It says on December 31st, 2019, the notes payable account at the Northwood Manufacturing Company had a balance of $16,000. So basically, if you go back to the previous slide on our interest calculation, that $16,000 is going to represent what's called the principal. So I'm going to write this up here. $16,000 is the principal. And then remember, we're going to multiply that by the interest rate. In this case, it says it's a 3-month, 7.5% note issued on November 1st. So remember what I told you, the way we do this is these interest rates are always annual. So we're going to multiply this 16,000 by 0.075, write this here, divided by 12. Okay, so what I do is I take this 7.5% and convert that into a per month or a monthly interest rate. Now the time period here is November 1st. So they started on November 1st. So what would have happened is the company would have debited cash for $16,000 because this is a loan. They would have credited a notes payable account. That's going to be your liability for $16,000. So when you go to a bank and borrow money, they call these notes, just like a mortgage in a way. And so, but remember, you have to pay interest on that note. And so in this case, the interest we're going to pay is 7.5% over 3 months. So in this problem, though, our accrual, because we haven't paid the interest yet, our accrual will be November 1st through December 31st. So that represents 2 months. So up here, I'm going to multiply my time period by 2 months. And so again, go back. Principal is $16,000. The interest rate in a per month interest rate is 7.5% divided by 12. Multiply that by 2 months. That's our time period. Believe it or not, that's going to give you $200 of interest. Your adjusting entry would be debit your interest expense for $200, and you would be crediting what they call an interest payable for $200. Okay, so and that's basically it. All right, so that's letter A. So let me get this out of our way. Now let's take a look at letter B. Letter B is, the rest of these should be, at least this next one will be a review one. That's one of your prepaid expense adjustments. So let's go back to that. So on letter B, this is where it says on January 2nd, This company bought some flash drives, paper, and other supplies for $5,230. On December 31st, it says an inventory shows that $1,590 were on hand. The supplies account had a balance, that's the ledger balance, of $5,230, so we have to adjust that. So in this case, all you do is you take the $5,230, you subtract the $1,590, and that's going to give you $3,640. That's going to be your supplies expense. So just like we did in Chapter 5, you would debit supplies expense, and you would credit supplies for $36.40. That would be your adjusting entry. That's letter B. All right, let's take a look at letter C. Now, letter C is going to be another prepay. So let's see, we've got, again, notice the time period. This one starts on September 1st. It says they paid a premium of $14,640 in cash for a one-year policy. On December 31st, they showed that the coverage for the period of 4 months have expired. So what they're saying there is that September 1st through December 31st is your 4 months. So we're going to make an adjustment to this prepaid insurance. So remember, you just take that $14,640. It's a one-year policy, and in this case, 4 months have expired. So we're going to divide that by 12 to convert that to per month, and then multiply that by 4, and that's going to give you right at $4,880. I'll write this one down here. So that will give you insurance expense of $48.80, and then you're going to credit your prepaid insurance for $48.80. So that, again, that one would have been review as well. All right, now letter D. Get this one out of here. We'll finish this problem up. All right, so on letter D, looks like we've got another prepaid. This one is prepaid advertising. So it says this one started on, looks like it's May 1st, and they paid $10,800. And the prepaid, and go back, it's a one-year policy. I was looking for the 1 year, so it's a one-year contract. So remember the calculation, it'll be $10,800 divided by 12 to get a monthly. And of course, remember May 1st is a starting point, so let's count this out. So you got May 1st through December 31st. So can you count it? May through December. That's going to be what, 8 months? So you're going to multiply this by 8. That'll give you looks like it's $7,200 of advertising expense. So notice you'll have advertising expense debit of $7,200, and then you're going to credit your prepaid advertising for $7,200. And again, I'll show you the exact solution on the next slide in case you can't read this. But the important thing is make sure you understand the concept and how to get the calculation. So again, $10,008 divided by 12 times 8, that's going to be your advertising expense adjustment. All right, so again, this is the solution in Blackboard on exercise 12.4. Just notice you've got, notice on the first one, debit interest expense, credit interest payable. There's your $200. Remember, that was the PRT calculation. The second one was your supplies expense. Then here's going to be your insurance expense, and then your advertising expense adjustment. Just note, just kind of remind you, the last three, those are all review from Chapter 5. So if you forgot how to do some of those, go back to your Chapter 5 learning module and review those illustrations as well. And of course, this is the new one, the interest calculation. Payable, initially what would have happened, go back.